One of the questions that is, well, sometimes asked in Washington these days, but always on Wall Street is, has the economy started to slow in the latter half of the summer going into the fall? From your perch in Richmond, what do you see?
Well, the economy took a deep dive, as you know, and it did come back quickly when we opened things up. But naturally, you would expect to see that recovery be a little more gradual. Where I see the real challenge now is getting the last 5% of Americans back into the workforce. And that's where I've got my focus.
Well, is that going to happen? What are CEOs, business leaders telling you about their plans to hire and to invest, to spend more money?
Well, there's a lot of uncertainty, starting, of course, with the virus, but also what the demand picture is going to look like next year. And in that context, I do think companies are streamlining, taking the last 5 or 10% and finding those efficiencies. I am starting to hear, though, in the last month or so, some amount of pivoting to tomorrow. And what I mean by that is, okay, we're going to get this behind us. Let's now talk about where we go from here. So I do think they've streamlined, but I'm at least hopeful that as we get into next year, you're going to see them starting to grow again.
Do we see growth, significant growth in the coming year, do you think?
Oh, sure. I mean, first of all, you've got a significant drop. And so we're going to grow out of that significant drop. I think you'll see a very strong third quarter, for example. But even going into next year, I think part of the legacy of rounding over the comps we have from this year is you'll see growth numbers that look strong. I look at more level than growth rates, and so I do think then the question is going to be, what do we look like year over year? And I still think, by the end of the fourth quarter this year, we'll still be down year over year, and it'll be hard to get back to where we were until sometime around the end of next year.
Well, is your forecast assuming we get a fiscal stimulus package? What happens if we don't?
Well, I don't try to assume anything in terms of what happens in Washington one way or the other. So, they're talking, and I think we'll let them figure out whether there's going to be a stimulus package. If there isn't one in the short term, obviously there's some people down in their luck who are going to get less support than they'd otherwise need. I'm more focused on some of the long-term issues, or maybe even medium-term issues. We have a lot of people who used to be, waiters or work at an amusement park, who now need new jobs, and their classic next job would have been working, at a retailer, or maybe working at another restaurant. If those places aren't hiring, how do we get them redeployed? And issues of job retraining, issues of getting Pell Grants and getting them funded. Those are the kinds of things I think that are important if we're going to bring the economy all the way back.
Well, another major issue, and you have one of America's biggest banks in your district, that is whether or not the economy can withstand as forbearance comes to an end and we see rising business debts and increased defaults, particularly for commercial real estate. How do you see that playing out?
Well, I do think this fiscal stimulus that we've done has been quite helpful to the financial industry. There are people who have been down on their luck who have gotten stimulus payments, and you actually see credit card outstandings down. You have some small businesses that would have gone under that got PPP money. You've got bigger industries like airlines that might have been much more significantly challenged if they hadn't gotten the money they've gotten. And I think so far, knock on wood, what at least I'm seeing from the banks is still pretty healthy.
What about in terms of their loans and lending, though? There have been concerns expressed that, particularly in commercial real estate, you're going to have a wave of defaults.
I think there will be challenges in commercial real estate, particularly on the retail side, as you could imagine. But then the question is just, are those defaults going to overwhelm the capital of the system? And my sense is there's been a lot of capital building in the last 10 years, and the exposures there compared to the capital in the system don't seem to compare.
If the economy is slowing, if things do turn south, is there anything more the Fed can do, or is it pretty much up to the folks in Washington now?
Well, we have done a lot, and I like to think, as I learned in college, that there's fiscal and there's monetary, and you want to pull both of them as strongly as you can. I'd say in this particular crisis, you could put public health on that list, and I think all three of those are levers we'll want to pull as hard as we can. And the Fed has done a lot. There's, of course, still more we could either do additionally or continue to do. But I'm actually more hopeful on where we're headed next year. And I'm hopeful that what we've done and also fiscal and the public health authorities will put us in a much better place.
Well, are you seeing demand for credit out there?
There is some demand for credit. Certainly auto credit has been very strong. Mortgage credit has been very strong. On the business side, I do think people took down their lines in March and April. They've, now repaid those. And I'm not seeing quite as much demand on the business side, in part because they spend most of the year with pretty strong cash positions.
One of the big questions about lending is over the Main Street lending program that the Fed runs. You issued a special senior loan officer survey last night that had banks saying overly restrictive terms for borrowers are discouraging them from approving more loans, and others cited the unattractive terms for lenders for not even making loans at all, not offering them. What do you do about that?
Well, I haven't seen that survey, but we designed the Main Street lending facility to play a particular role. It'll be a bigger role if bad news happens and the economy goes south. But if there are loans coming into banks, they get the option of whether to keep them or whether to sell 95% of them off into our Main Street facility. And I'm not sure it's bad news if they're making those loans and keeping them.
All right. The Fed in June banned buybacks by banks and capped their dividends into the third quarter. Should that ban and cap be extended? Big debate right now.
Well, I think we've put in place a protocol that allows us to have a deep investigation into the quality of the capital levels of the various banks. And my view is we ought to do whatever we do on a bank-by-bank basis. And those banks that need to conserve capital ought to be conserving capital, and those banks that have sufficient capital ought to be free to distribute it.
All right, I got to ask you about the new framework and your view that things are going to pick up in the economy going forward. Does that mean inflation is going to pick up as well?
Well, there may well be some inflation, particularly in the near term, if demand comes back stronger than people think at a time where supply chains are stretched. But our framework is not around any particular month or quarter's inflation. It's much more around where we headed in long-term inflation expectations. And my hope is that those will start to creep up back toward our 2% target.
Well, the new policy is that, of course, appropriate monetary policy, in your words, will likely aim to achieve inflation moderately above 2% for some time. For Tom Barkin, what does moderately mean, and how far above 2%?
Well, let's see when we get there. But I think I gave a speech, Mike, you were there in Idaho a year ago, where I said I'm very supportive of a range around 2% and a moderate range around 2%, whether that's 1.5 to 2.5 or 1 to 3. I think I said I'm not that focused on the difference between them. But that's something close to, or as somebody put, I think recently, the word moderate means moderate.
Yeah, that somebody was the chairman who also took pains to say over and over in his news conference that the new guidance is strong and powerful, which does not seem to be the read on Wall Street. Why do you think there's a disconnect there?
Oh, I don't know if there is a disconnect.
The analysis on Wall Street basically is that you can move interest rates, but you're not going to have much impact on the economy unless demand for credit picks up, unless something is done out of Capitol Hill.
Well, I just say there's a difference between looking backwards and looking forwards. I think for the last 6 months, we've gone pretty strong in terms of what we can do to support the economy. And now we're looking forward over the next year or two. I think the forward guidance is particularly powerful as the economy comes back, as I think it's going to. And so if you do see a strengthening economy, if you do see modest overshoots of inflation, I think we're going to be having a different conversation.
One of the other things that people are watching in terms of overshoots is the equity markets. Lower for longer, raising financial stability concerns, particularly with PE ratios getting to where they are. Are you worried at all that your money that you're putting into the economy may be ending up in the wrong place, stimulating equity acquisition and share buybacks and things like that instead of stimulating growth?
Well, I'm not a believer that lower for longer means zero forever. I do think I want to normalize at some point, and I want to normalize in part as a response to a healthy economy. So I don't really watch the equity markets as much as I watch leverage levels. And the thing I would be nervous about is if you start seeing leverage in particular sectors that made you concerned. I don't think that's where we are yet.
You're not seeing dangerous changes in borrowing patterns then?
Well, actually, credit card outstandings are down. And, as I said before, the pipelines on the business side aren't overwhelming the banks. So I don't think at this moment in time, that's what you're seeing. But of course, when you do have low rates, that's one of the things you want to watch. But again, I think at this point, the banks are tightening standards, not the other way around. And so I don't really see that as today's issue.
All right, before I let you go, I got to ask you, because I know this is an area of interest for you. Has the financial crisis we're undergoing now changed the dynamic for the economy in terms of inequality? A lot of talk these days about a K-shaped recovery.
Well, if you look at the last 30 or 40 years, the mega story has been the decline in middle income jobs and the growth of both the high end jobs and those at the low end. And the sad part about this crisis is those low-end jobs, which are disproportionately low-income, personal service, personal contact workers, waiters, amusement parks, retail folks. Those are the jobs that have been hit the hardest. And I do worry that group of people who have been brought in off the sidelines over the last 5 or 10 years of a healthy economy are now displaced, and their next best job is also displaced. And so this question of, what are the things we can do to help those people re-engage in the workforce and rebuild their careers into some of the places perhaps that are, hotter, whether they be, healthcare or manufacturing or construction or whatever. That's a pretty important thing for us to work on. And if we don't do that, I do worry about what that's going to do for inequality.